Welcome, everyone, to this Legal Office Hours. Today's topic, financing your deal, SBA versus non-SBA. My name is Will Smith. I'm the host of the podcast Acquiring Minds and a partner in Minds Capital, a fund that invests in independent sponsors. Attorneys James David Williams and Bill Barlow are going to host this session as they do for all of our Legal Office Hours. James David and Bill are partners in Barlow and Williams, a practice that specializes in small business M&A. They're at the front lines of our market. Their focus is on helping searchers and sponsors like you do your deals. They also represent sellers, so they see both sides of transactions in this market. They've invited Adam Steiner to join them today. Adam is a partner at Rick Steiner, Fell & Benowitz, and Adam represents buyers and lenders with a focus on independent sponsor deals. The way we'll run today is, as always, Bill, James David, and Adam will give their presentation, and then we'll do Q&A. To ask a question, use the Q&A button. We don't use comments. If you have a very involved question, maybe specific to a live deal, probably won't get to it. Ask it anyway, and James David does his best to always answer all questions after the fact. He'll contact you directly. If you do that, or want that, just make sure that you're not logged in anonymously, because then he can't get your email. So you need to be logged in with name and email address. We're recording the session as always, and you'll get a link to the recording and the slides either today, but more likely tomorrow in the case of this week. And I'll put some links in the chat to emails and websites and socials. But while I do that, Bill, James, David, I'll hand it over to you.
All right. Well, thank you, Will. As Will said, we're Barlow and Williams. We are an M&A law firm that specializes in this space, both SBA and non-SBA transactions. What we're going to be talking about today in broad strokes is basically about the your options in terms of financing. Actually, before I get into the weeds of that, though, let me introduce our special guest, Adam. So to give you just a little background, we do a lot on the SBA and non-SBA side. Whenever we have a deal that doesn't involve SBA financing, Adam is kind of a go-to guy for, helping us think through a lot of those issues. So Adam, if you could kind of introduce yourself.
Sure. Thanks for having me on, Bill and James David, and Will, nice to meet you as well. I'm a partner of Rick Steiner, Fell & Benowitz in New York. My practice focuses on independent sponsor finance, often on the borrower side, sometimes on the lender side. I also represent lenders on conventional and SBA finance as well. And in that, I've probably closed thousands of SBA deals, 7As and 504s, and thousands of conventional finance deals as well. So I'm excited to be here and to interact with everybody, and let's get started.
All right. Okay, so just broad overview, what we're going to be talking about today is the different ways in which you could use debt financing for your deal. There are SBA deals and there are non-SBA deals, and as you'll see, there's a really big difference between the two of them. There were also some recent rule changes this year in the SBA land. So the goal is to give you an overview of things you should know about as you're kind of going into the process and what is available to you on both the SBA and the non-SBA side.
Yeah, so we'll start on the SBA side because in many ways that is simpler, just in terms of it's more standardized. So SBA loans, 7A loans is kind of the general program. And when we talk about 7A or 504, those are different sections, right? It's a different program. 7A for businesses, 504 for real estate. Terms are a little bit different. But the 7A is going to be a 10-year term and straight line amortization, nothing fancy about that. The real estate, the 504 can get up to 25 years, and sometimes there can be a blended amortization depending on how the total deal value is split between the business and real estate. So sometimes there's reasons to buy the real estate if it pushes out the length of the loan. In certain deals, in other deals, it doesn't make sense. If you're doing the 7A loan, you, as the buyer, are going to be required to give a personal guarantee. That is one of those non-negotiable elements. What that covers can vary a little bit, right? If you happen to live in the state of Florida, for example, like your primary personal residence is going to be excluded from certain guarantees because of Florida having a homestead provision in their state constitution. But for general purposes, people should just assume that that's going to be a general kind of personal guarantee for everything. When it comes, so the notes about lease terms here. So if you are leasing the real estate as part of a 7A acquisition, there will need to be, it doesn't have to be a 10-year lease. Some people kind of misunderstand that, but there have to be options, renewal options for the lease to cover the full 10 years to match the term of the loan. That's going to be a requirement. Okay, and Bill, you can have the next slide. You get the fun.
Yeah, a couple other things to think about. It is very common to have what are called seller notes. So seller notes, oh, and on the collateralization, all the assets of the business will be collateralized. You know, any of your personal assets are subject to the personal guarantee. And by the way, Adam, I should just say, if you ever feel want to jumping in here, you could always feel free to do that. On the SBA financing, a lot of times there are seller notes in almost every deal. Not every deal, but it's very common to have a seller note. A seller note is basically just the seller is accepting that some of the payment will be made to the seller over time. So you might have 10% of the purchase price that's paid over time. There are some requirements about those seller notes. The first thing is that they're always going to be subordinate to the SBA loan. So even if they take a security position, a security interest, it's always going to be subordinate to the security interest that the SBA lender has. You may have heard that seller notes can count towards the equity requirement. So in an SBA loan, let's say that you're buying $1 million business, there's a requirement that you put in 10% of that, so $100,000 as your own personal equity. Now, it used to be the case that in some situations you could count a seller note towards that equity. And that still is the case, but it's a lot more restrictive now. So now, number one, you can only count about half of the equity can come from a seller note. And the second thing is that in order for a seller note to count as equity, it has to be on full standby for 10 years, meaning there's no payments of interest or principal until the entire 10 years are complete. So as you can imagine, there are a lot of sellers that are not very excited about the idea of waiting 10 years with absolutely no payments to get, their money. But in that scenario, you're buying a business for $1 million, you have a $100,000 equity requirement. If a seller was willing to give you a $50,000 note that was on full standby for 10 years, then you'd only have to put in like the $50,000. The other thing is, increasingly in this market, there are investors that are coming in. They are, helping you provide equity for the deal, especially on larger transactions. That is allowed, but there are some restrictions. First of all the investors have to be, and this is true of you as well, have to be U.S. citizens. And another thing is that the way they structure their investments cannot essentially force you to pay them before the SBA loan is repaid. So sometimes you might negotiate things like put options, and sometimes those things have to be deferred until the SBA loan is paid off, in order for it to be kosher for the SBA standards.
I'll also add here before I move on to the next bit that some of the great thing about the SBA loan, or one of the great things about these 7A loans, is that they don't have a lot of covenants. Covenants is something we'll talk about later in conventional financing. They're sort of restrictions on how you operate in many ways. And SBA loans right? They're covenant free with the exception of payment. Right, that's the only covenant under these loans. So it's one of the beauties of the SBA loans is that you're free to operate the business as you want.
And I'll also add one more thing that we probably should have mentioned earlier. In terms of the personal guarantee, when you're buying it, it applies to everybody that owns 20% or more of the buying entity. So sometimes you could have a partner who's going under 20%. They don't necessarily have to provide the personal guarantee, unless they're the seller, which we'll talk about in a bit.
Yeah, and now I'm going to complicate exactly what Bill just said. So in there's sort of special rules in certain circumstances. So SBA deals, it can either be a total buyout where you are buying the entire business, and that can be either a stock purchase or an asset purchase. The other possibility is something called a partial buyout, where you as the buyer are buying, 80%, 90%, and the seller is maintaining 10%. So in that world, it has to be a stock purchase for one thing, but there's also different rules around the personal guarantee in that scenario. So let's say, for purposes of this slide, it actually gets more complicated on the next slide, but simplified here, you've got one seller, you're buying 85% of the business from the seller. So the seller is going to maintain 15%. So we're under that 20% threshold. If we were 20 or more, then they would have to guarantee it for the full amount of the loan. But if we're at 15%, then that seller is going to have to guarantee the SBA loan for at least 2 years. And the way it's written, some people have said that it's just 2 years, but it's actually, if there's a missed payment, it would extend. So it's 2 years of full payments that the seller has to guarantee the loan. Obviously, seller's not especially keen on that. And so we have seen transactions where this happens. It tends to happen more in the trades for licensing reasons, is where this scenario is the most common. But obviously, sellers aren't keen to guarantee a loan when they're not in control of the business anymore. And then I'll add even more complexity in the world where so say that there are multiple sellers, right? So the prior example was sort of a single seller, but let's say that there's 2 or 3 sellers, and it's possible that, say we have three sellers, one is retiring, right, is being bought out completely. One wants to take some chips off the table, but still wants to work in the business for another couple of years. And the third, maybe some employee who had a couple of percentage points and is just going to maintain the same. It's going to maintain the same ownership. All right, so we've got 3 different scenarios: one getting cashed out completely, one getting cashed out partially, and the third is going to stay the same. So they get different treatment for purposes of the SBA loan and having to guarantee. So the person that gets cashed out completely, no guarantee required. The person that is partially cashed out has to has to do the 2-year guarantee that we talked about on the last slide. And the person where the ownership stays the same doesn't have to guarantee at all. Now, also to add even more complexity to these partial buyouts, and these rules, this all came in as part of the rules update this year. But the partial buyouts don't really lend themselves to investors because anyone who gains equity in the transaction, so anybody that gets even 1% at the time of the transaction, has to fully guarantee the loan for the full 10 years. Don't completely understand why that change was made in these rule changes, but it makes it really hard to get investors in partial buyouts is the net effect. And it can complicate having an operating partner also. I've seen that happen. So in short, with partial buyouts, things are a little bit wonky.
James David, could I
Yeah.
just make sure I understood that last point?
Mhm.
In a partial buyout situation, so sellers rolling some equity, any other equity that comes in, namely an investor that's helping me, with my equity injection into the business, has to guarantee.
Yes.
Wow.
And that
Okay.
makes it really hard for kind of obvious reasons.
Yeah. Wow. Not sure I knew that. Thank you.
All right, so the next thing we'll talk about is pari passu lending. So it's just a fancy French word because we lawyers like French words and Latin words, and it means on the same footing. So pari passu lending usually happens when, and just as a little bit of a background, the SBA limit for the 7A loan is $5 million. So if you want to buy a business that's like, $20 million, you're just not going to be using SBA lending. There are, however, some situations where you might want to buy a business that's like $8 or $9 million, and it's a really strong business, but you hit that $5 million cap, and you're like, I don't know how I can finance the rest of the 3 million or the 4 million, whatever it is. This is where pari passu lending can be an option. There are uh, uh, much fewer lenders that offer pari passu lending, but basically what they do is they help you bridge that gap by lending additional funds at that on basically the same terms as the SBA. Just know if you're doing this, you're in for an even more extensive underwriting process. Just know that there's a lot of SBA lenders that don't do this. But there is, and we'll talk about this in a little bit, there is this kind of gap in the market where kind of SBA runs out because of the $5 million cap. And like a lot of the non-SBA debt sources often don't like to play with you unless you're like at least at 2 million EBITDA. And this can sometimes be a place to bridge some of that gap for the right type of company.
Okay, now we get to the fun stuff, where it gets a little bit more free form, I'll say. Uh, so maybe Adam, you want to start, or do you want
Sure. Sure. So as James David mentioned, SBA loans are covenant light. Make your payments and you're pretty good. Once you get into traditional debt financing, meaning non-SBA, there are really two different paths. One, sometimes you get financing from a regular bank. Conventional lenders do M&A finance for really, really strong deals. Otherwise, you're likely looking at getting money from a debt fund, an SBIC lender, a debt fund lender, a mezz lender, whatever you want to call them, however they're structured. And now you're in the Wild West. So whereas, for example, you'll get 90% leverage on a 7A, on a debt fund deal, you might get substantially lower leverage, or in theory, potentially in very, very strong deals, even higher leverage. But typically much lower. And the reason for that is that the limits are determined by assets, by hard assets or cash flow, and by the business. On these conventional finance or traditional debt financing deals for these independent sponsor deals, you have many other covenants that appear. So a few of them would include a debt service covenant. Does your cash flow cover the expected debt service? Fixed charge coverage ratios. Does your cash flow cover not just your debt service, but other fixed costs that you're going to have? Meaning, what are the chances that you might default on some other agreement with some other party that might impact the lender? You'll have excess cash flow recapture covenants, so that the lender wants to make sure that they're going to get paid back as quickly as possible. So not only can you not make distributions to yourself or your investors for the period of time that you have the loan, but if you have more than a certain amount of money in your bank account, there's excess cash flow at the end of the quarter or the end of the year, you have to make a mandatory pay down of your loan. All excess cash beyond a certain amount will get swept to that lender. Not only that, but very often in the traditional debt finance piece, and we'll probably speak about this a little bit later, you very often will have a working capital lender. So you might get money from a fund for the acquisition, and then you'll go to a bank to get a line of credit. And the line of credit will be financed or secured by the receivables and the inventory of your business. But your senior lender wants to make sure you don't have too much leverage. So you'll have a leverage ratio that you can't exceed. I've seen them as low as 2-to-1 relative to your consolidated EBITDA and as high as 4.5-to-1. The idea being that your lender wants to make sure that you're not running amok and just gathering up debt that could put them at risk. Sometimes you'll have your loan will be obviously for a shorter repayment period. You're not going to have a 10-year loan that's fully amortizing. You might have a 3-year loan, a 4-year loan, a 5-year loan. It might be interest only. It might be interest only for just a short period of time. And it might be interest only with mandatory principal repayments at various times. So instead of paying principal monthly, you might pay principal quarterly or semi-annually. And by the way, when we're talking about those ratios, again, these are much higher interest rates than you're going to get on an SBA deal. You're looking at, in some cases, I've had it SOFR plus 8, SOFR plus 9, SOFR plus 10 as your rate. And so the lender, again, wants to make sure that the loan is being paid off and being paid down. So your coverage ratios might start off at, let's say, a 2.5-to-1 or a 2-to-1. And then every quarter they'll ramp up. So after the first quarter, it might be 2.25. Then after half a year, it's 2.5-to-1. The idea being that you're paying down the loan and you're growing the business. So the ratios that you have should continue to improve as you continue to run the business. So you bought the business and your debt service is a 1.3-to-1. Well, a year later, if you've grown the business and paid down your debt, that should be at a 2-to-1. And the lender's priority is making sure that they get paid back, not that you're going to take that money and distribute it out or use it to buy a new car for the business or a new vehicle for the business or invest in something else, pay them back. So while they'll give you money to work with and invest in the business, they still want to make sure you're getting paid down or they're paying down. And one of the ways they do that is to make sure that your covenants become, in a sense, more restrictive as the time goes on. Your closing costs, substantially higher. Bill, James, David, why don't you give us an idea of what you see as lenders' counsel fees on a typical 7A, like what the range could be?
Well, the funny thing is that a lot of times those will kind of just get absorbed within the loan. And I mean, I'm not to say that they're just like invisible, but you're not really coming out of pocket for them. And you're seeing like lender counsel getting paid some charges. And I think like the SBA fee is like sometimes 30,000 or something like that. And then there's some like counsel fees and I
The
don't know.
lender fees are quite a bit less than that, though.
Right.
Yeah.
Right. You have your guarantee fee, 30 grand. You might have your counsel fee, $5,000, $10,000 on a 7A. I have seen on traditional independent sponsor deals, counsel fees over $100,000. Right. So when you're modeling this out, not only, when you're modeling out your SBA 7A acquisition, you know what your debt ratios are going to be, you know what your P&I is going to be, and you know you have to cover that, and you know what your expenses are going to be. When you start doing it on non-SBA deals, the underwriting becomes a lot more complex because today you might have to be at 1.25. A year from now, you might have to be at 1.75. And your cash to close on an SBA deal, your major cost, your SBA guarantee fee, your lender counsel fee, your acquisition counsel fee. Well, now you have all of the lender's fees, a point or 2 points on the acquisition, on the origination. Lender's counsel, $50,000 to $100,000, sometimes even more, right? So the costs for making the cost of those closings go up tremendously. Depending on who you're going to and what their structure is, they might participate out that loan as well. So you might be dealing with multiple lenders. They might be what we call an administrative agent for 3 or 4 different lenders, which again will increase your time to close and also increase your cost to close. So from that perspective, there's a very, very, very big difference between SBA financing and non-SBA financing. As I mentioned, excess cash flow often will go to repay the loan. You will have to get, at a minimum, compiled statements from an independent CPA. Most often, you'll have to get audited financial statements. You will be reporting to your lender monthly. They want to see your bank statements every month. They will want a cash flow report, usually every month. They will really, when you buy a business with SBA financing, the day after the business you close, you're walking into the business and you're running the business. The day after you close with traditional or independent debt sponsor financing, you're walking in to run the business and you're talking to your lender. The lender doesn't disappear. They're literally there with you almost every step of the way and make sure that you don't default, right? If you have a payment default on an SBA deal, you're in trouble. If you have a technical default on an independent sponsor deal, you're also in trouble. Very often, the lender on traditional debt financing from a debt fund will want an equity kicker. So they will take warrants in your company. Some of them will want to make an equity investment alongside of you, but other times they'll get warrants that have a put option after a set period of time. They could be penny warrants or warrants for value. That just impacts the percentage that they're going to be requesting. But they very often will want some kind of equity stake in the company. And the last point on this slide is working capital line of credit. I mentioned that simultaneously with your traditional debt finance, you're going to be speaking with lenders about getting a line of credit for working capital. And that line of credit will be secured by receivables and by inventory, depending on the type of business that you're running. And part of this, the reason you want that is number one of the other covenants, one of the other ratios that your lender will want is a liquidity covenant. They will want to make sure that between a working capital line and working capital in the business, you'll have at least a certain dollar amount of liquidity available to run the business. They don't want you 6 months in to have no working capital availability and no liquidity availability. So what do? They put in a liquidity covenant. You must maintain at least $1 million of liquidity, which could be through the use of a line of credit or the undrawn portion of a line of credit. What I will say is that you want to try and close your working capital line of credit simultaneously with your acquisition. Sometimes they close after, but you often want to close it simultaneously. And the reason is that liquidity is key. Working capital is critical. You never want to have a scenario where you're short of working capital. You never want to have a scenario where you're short of liquidity. This is true in the SBA world as well, right? But also in the independent sponsor world, you need to make sure you're going to have ample liquidity. The number one issue that I see, and admittedly, there's a little bit of confirmation bias because I'm debt counsel. The number one issue I see is a lack of working capital and a lack of liquidity. So making sure that you have that lined up and making sure that you're able to run the business without worrying about your liquidity is critical. Okay, general tips.
Yeah, that's the last slide.
Financing, it takes a lot longer than you think. A lot longer, especially in independent sponsor deals. The underwriting is substantially more complex. As we talked about, the models are more complex. You're not just modeling out debt service at a certain ratio to make sure you can make your P&I payments, but you're modeling those covenants ratcheting up so that if you're not growing and you're not paying down your loan a year or 2 years in, you can default because your coverage ratios no longer are what they were at the time you acquired the business, but they've gone higher. Lenders will back out. They might back out because they discover something bad about your business or something they don't like. They might back out because their fund mandate changes, or because they've decided to commit capital to another deal. Always shop it around, always get multiple term sheets. Life insurance, very often, an independent sponsor lender will want a key man policy on the key people. Now, those key people could be the sponsor, it could be you. It could also be an employee that's staying on, that's run the business for the last 10 years, or a basket of employees, 2 or 3 of those employees. They may have medical issues, but they're going to want life insurance. And they will give you time post-closing to get that life insurance. But you want to try and wrap that up as soon as possible. Once you're comfortable with the acquisition going forward, start working on the life insurance aspect. And I would say that even if your lender is not requiring life insurance, if you're an independent sponsor and there are key people in the business, you probably want to get life insurance on them to begin with. I have a friend who bought a business independent sponsor purchased a business, the existing manager stayed on. He got a life insurance policy on that manager as he should, and terrible story, but literally like a week later, the guy passed away. And had he not had life insurance on that person, on that key employee who's going to remain with the business, he probably would have lost everything in that acquisition. So life insurance, the lender is going to probably want it, but you should really consider, to the extent that you are going to be relying on people for a year, 2 years, 3 years, you should consider having them taking out policies on them as well. And as I mentioned, working capital, liquidity are critical. What I'll also add, which I think is important to reference, is another major difference between 7A loans and independent sponsor loans are the personal guarantees. People are, I think, justifiably scared of pledging everything they have and putting their financial stability on the line on a 7A deal. You often don't have a choice. But in the independent sponsor world, you can often get rid of a PG. Now, you pay for that, meaning you may get rid of the PG, but they're going to want to make sure, the lender's going to want to make sure you have a certain amount of equity in the deal. They're not going to necessarily get rid of the PG if you have no money and no skin in the game. But if you can show you have skin in the game and you can show that you do have the financial wherewithal to support the business, they're more likely to allow you to waive a PG. So that's just another item that I think, another item that pops up.
I'll just turn it back and reiterate again, in the 7A world. If the bank offers you a working capital line of credit, take them up for every dollar they'll give you. You don't necessarily have to draw on it, but like you really want to get as much availability for liquidity as you can, because it's very hard, if not impossible, at least for a period of time, to obtain additional financing post-acquisition.
Exactly. If they're going to give you a line of credit, remember, in the 7A space, if they're offering you a line of credit, they've already underwritten your deal. They've made you an offer for a 7A loan, and they're making you an offer for a working capital line. You don't want to have to go somewhere else to try and get it. To James David's point, you're not going to be able to, because on the 7A, they're going to take all assets. Now, when there's a working capital line, they'll pledge the AR. And getting a bank to release their claim on the AR on a 7A after you've closed, so you can take out a working capital line secured by AR somewhere else, is going to be a non-starter. So if your 7A lender is offering you a 7A loan and a working capital line, take them up on it. You don't have to use it, but you got to take them up on it.
Well, great. I think that basically covers most of it. One other thing I'd just like to mention, because I think it might come up, because of the nature of the presentation, SBA, non-SBA, it kind of makes it seem like you're going to have a lot of times a choice between SBA and non-SBA. I just want to warn you that that's usually not the case. Usually, you're either going to be in the SBA bucket and there's not going to be any non-SBA lenders that are interested, or your deal is going to be so large that SBA is just not a possibility and you have to be in the non-SBA. There are some times where you can choose between, but if you're coming with like a traditional $4 million acquisition and you're an ETA person and you listen to this presentation and think, oh, maybe I should explore the second option, I'm just telling you, non-SBA is almost certainly not going to be an option. There are limited exceptions if you have like substantial assets to hide, that you already have and other things like this. But I just want you to know, as part of this whole conversation, that, I think Adam actually said this before the presentation start, the Venn diagram between these two financing sources doesn't have very much overlap. So
I'll give you some actual numbers. I think I'm on pace right now. I mean, I do a lot of financing on the lender side as well on the SBA space. My firm will probably close about 200 7A loans this year. I don't have the actual numbers, but I think that's what we're on track to do. In that space, meaning loans up to 5 million that are business acquisitions that are non-SBA, I think this year we're going to do 2. Right? 99%. And the reason for that is that the 7A is designed for this kind of product. It's very covenant light. It's, aside from the PG aspect, very borrower friendly. And so that really sucks out a lot of the space in the market for anyone else that wants to be in that area for an acquisition. If you're coming with an acquisition and you have a strong track record and you have strong assets, and it's a good deal, yes, there are conventional lenders that will do a sub $5 million business acquisition, right? But if regular run-of-the-mill business acquisitions, you will have substantially easier time SBA. And really, in again, 99% of cases, it's your only choice.
All right. Well, that was our presentation.
Sorry, didn't mean to scare anybody off. What I will say, I'll add one more point actually on a differential between the SBA and non-SBA lending, and then I guess maybe we can turn it over to the Q&A. In the SBA lending world, if you're going to go and reinvest in the business, you want to go buy trucks or vehicles or equipment. There are ways of going about doing that. In the traditional debt finance space and the independent sponsor space, you'll have a basket or a bucket of money that you can spend for that. So you want to go buy vehicles, the lender will say, great, as long as it's not more than $250,000 outstanding at any one time. So on some level, again, the Venn diagram really has no overlap. You're either here or you're here. But if you're in the independent sponsor space, you will negotiate, how much can I spend buying new equipment or new vehicles or new whatever for my business? That's not something you're even going to think about asking, and not even something you're going to ask in the 7A space. But all of these things become important questions in the independent sponsor world. One more example. It is very, very common in the independent sponsor world that because the lender is a debt fund, they're not a bank, but their collateral includes the cash you have in banks. So you have what's called a DACA, a Deposit Access Control Agreement. The bank or the lender takes a lien on your bank account, and they can seize that bank account if you default. Well, there's a special agreement between the fund, the lender, you, the company, and the bank that you have your money at, and it's called a DACA. That DACA will happen post-closing. You might like to get it done before closing. Very rare, half the time it never happens until a month or two later. But that's something that just another headache that you'll have, another group of attorneys that have to get involved potentially on the bank side sometimes, but a question that never happens in the SBA context or rarely happens in the SBA context. So again, there's just a lot more complexity on the independent sponsor side. You would also expect that if you're buying an independent sponsor deal, the business is probably a little bit more complex than a standard SBA deal, though I'm sure that's not always the case. But again, it's really two different worlds.
Great presentation, all. If a little disheartening, if there were people who came hoping to find alternatives to the SBA for a deal of kind of searcher size. It's a little counterintuitive that the conventional debt or the debt options for independent sponsor deals, which are bigger, more robust businesses, less risky, i.e. less risky, that the debt is so much less appealing. I mean, other than the lack of PG, which by the way, also could still exist, but let's assume it doesn't. Other than the lack of PG, everything about debt for these larger deals was way less appealing, Adam. Is this just the effect of, a government program that's essentially subsidized?
I think so. I think the SBA makes it, well, I think that's the point. Meaning the SBA's goal is not to make a profit necessarily, right? Their goal is to support the acquisition of businesses. The lenders, the debt fund lenders, they have investors that they need to make a risk-adjusted return to, and that's going to also push up the price. If the SBA came in and raised their limits to $15 million, a lot of that debt fund independent sponsor space would probably dry up and go out of business. But I think people tend to underestimate how risky having someone buy a business when they don't have any experiences, right? If you have no experience running a business and you're going and acquiring something, there's a lot of risk there. But if you're a sponsor and you have a track record it's not your first acquisition, and you can show a lender that you're doing, that you know what you're doing, then you don't have to go the debt fund route. Even if it's bigger than SBA, you can go conventional financing. There's plenty of M&A that happens in the conventional financing space with conventional institutional banks, but it's still few and far between, I think, in the ETA space, because it's higher leverage than a lender would want to do. The sponsor doesn't necessarily have a track record to run on. So you're going to a bank, hey, I want to buy this trades business for $15 million. Well, that's great. Show me what you know. Well, I just graduated from business school. That's not the profile of the person who's been running a business for 20 years and says, hey, I want to do an add-on acquisition for $15 million. Will you finance it?
Yeah. Well, all the more reason for us to be thankful that we have the SBA program.
100%.
Boy, are we fortunate. It's interesting because I have had guests on the pod from Canada, from other places, who buy kind of self-funded size deals, SBA size deals, and get it done. So there are options in other places. I guess the point is there are options because the SBA doesn't exist there, and so for-profit lenders can compete. Yeah. So until in some ways the SBA is a great gift, but if the SBA disappeared tomorrow, we might see options. The market, create options for us.
There would just be a lot fewer transactions taken.
Right. It's hard to
but
tell.
They're not going to be as good. Yeah.
Right. It's hard to tell how much the SBA or how much the 7A program is manipulating the market in the sense of lowering transaction costs and thereby allowing people to buy, versus also expanding the pie. So that, like James David was saying, if the SBA disappeared, we might find bank lenders or fund lenders coming into the market at much lower dollar amounts to deploy and much lower rates potentially, but we'd probably also see the number of deals decrease substantially. That would be my guess.
Because those lenders would be more selective about who they lend to.
And
Right.
that's what you see in other countries, right?
Right.
Yeah.
Right, because the SBA is subsidizing it. The SBA is taking on that risk.
Right.
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 What is the criteria for a 7A loan is that the credit can't be available elsewhere. I mean, that's one of the requirements, right? The banks can't, if a bank is offering a 25-year product at whatever, that on the same terms, they can't really offer you a 7A loan. So 7A is intended where the banks will not go, where the lenders will not go. Why don't the lenders go there? Well, because there's an SBA that allows it to happen and takes on that risk. If the SBA wasn't there, lenders would have to fill that space, but they'd be a lot more conservative.
Yeah.
A lot of times the deals in Canada and stuff, we find that they are lending to people that already have a pretty robust balance sheet. So you're not as much seeing new people jumping into the territory and, wanting to leave their corporate job and buy something. It's more somebody who already has quite a bit of resources who is then looking to do this. And the multiples of the businesses are substantially lower as a result. So you're getting much more 2, 3x, you're not getting any sort of 5x in these small businesses because the pool of buyers is substantially lower.
What I'll say is,
well, that's another interesting point. Is despite the fact that we're all celebrating the SBA, it has had the effect of probably making these businesses more expensive. So it has had one negative effect.
Yeah.
right. I would also add that you could probably see some of this already if you look at the secondary SBA market, meaning the gamut of SBA lenders. You have some SBA lenders that will fund out any acquisition, not any acquisition, but are more risk tolerant, and some SBA lenders that are more risk averse. Right. My suspicion would be that if the SBA disappeared, the risk averse lenders would probably be what we're seeing from a credit criteria standpoint. But again, we don't have to get too far into the details on that.
Yeah.
Adam, do you have any sense of distressed SBA 7A loans? So we always talk about the default rate, but the default rate only counts those loans that are actually in default, but we assume that there's some additional quantity of people above that, borrowers above that, who are going through distress, who are having fetal position moments, who are going through hell, even if they don't show up in the data. Do you have any sense of what that strata is?
I don't know how large the strata is. I get at least one call a week from somebody to talk about those, or where they're going through some kind of issue and they want to discuss it, it's definitely there. I think it's probably when interest rates were at their historic lows, and SBA 7A variable rates were in like 5, 6, 7%, and then jumped up to 12. That I think caused a lot of distress. As now rates are starting to come down as the prime rate decreases, I think some of that interest rate stress is alleviating. The flip side is that in certain areas, the economy doesn't seem to be doing as well as people expect, and multiples are fairly high. And so that is causing some business distress as well. So there are definitely deals that have been done that are, sort of hanging on by a thread, and the sponsor is probably having trouble sleeping at night, unfortunately, right? In those cases, my advice is always reach out to your attorney as soon as possible. Speak to the bank as soon as possible. You don't want your lender on the SBA side or the non-SBA side. You don't want your lender to find out there's a major problem after it's too late to be solved. You don't want them to find out there's a problem after you stop making payments, right? Be proactive about it. Sit down with them, start working it out, and figure it out.
Great. What a good presentation, guys. Okay, so we have 47 questions. We're going to get to probably 5 of those 47. Let's start with Nazim's question here. We were talking about this a little bit offline. So what is the ability to upsize the SBA? Sorry, let's do this question. Separate question from her. How soon can one refinance an SBA loan with non-SBA debt? And what is generally the marker for when one can do that?
Perfect. So generally speaking, you can refinance an SBA 7A loan into another 7A or into, conventional corporate debt at a bank through any of them. Most banks will have it. I speak to them all the time about this. The general approach is you need 24 months. You need to be running the business for about 24 months. And then obviously, revenues have to be increasing, margins should be increasing. If you've been running the business for 24 months and your revenues are down and you're not as profitable, you're gonna have a much higher hurdle clearing your credit criteria or your credit underwriting. But you've run the business for 24 months, you're doing a great job, then after 24 months, you should be able to refinance.
Great. You answer this, but let's ask it again. Do SBA lenders allow you to get a working capital line of credit from third parties?
I mean, it's highly unlikely to happen, just given the nature of what assets get securitized for purposes of the SBA loan. So for all intents and purposes, no.
And so your point there, James David, is it's not a rule by the SBA. It's the fact that a third party working capital lender wouldn't do it.
Yeah, nobody's going to do it.
Yeah. Great. Rules on permanent resident citizenship, et cetera, on SBA. So you need to be a permanent resident to qualify for SBA, not just a citizen. Well, no, you need to be a citizen, not just a permanent resident. What are the rules there, please?
Lawful permanent residents with certain visas. We don't do immigration, but lawful permanent residents, like green card holders, permanent green card holders can apply.
Okay.
But you can't be on a temporary visa and apply.
Okay. So somebody asking on this point, again, James David, that we talked about, for SBA 7A acquisitions, did you say that investors in the deal have to PG the loan, or only if it's a partial acquisition?
Yeah, that's only in a partial buyout. In a total buyout, investors would only have to PG if they exceed the 20% threshold. So if the total buyout, investors taking 15%, then no PG is likely to be required.
And so effectively, searchers, what that means is that if you're going to take investor capital, the seller cannot roll equity.
Pretty much.
Are there specific SBIC funds that you've worked with to help fill the gap between SBA loan and acquisition purchase price where pari passu won't do it or it's not offered?
Yes, I've had loans that are in the, with SBIC funds that are in the $7 to $8 million range. That will cover that gap between, that will cover that gap within that range. They do exist.
Okay. Are there any above board strategies for excluding a personal residence from the PG?
Whew. So what I'm gonna, there's also another equity residential question there that I'll answer both of them at the same time. The first is you could take out a HELOC, a home equity line of credit. The lender will then typically treat it as fully drawn from an underwriting perspective, even if you don't have any money on it. So if the lender is looking at your credit strength and you have a $1 million home with a $200,000 mortgage and a $700,000 HELOC, they're going to treat your home as having $900,000 of debt. The 30% equity route is not a rule, meaning you could have less than 30%, and I've had plenty of 7A deals where the equity available in a home is less than 30%, and the lender will take it as collateral. So, don't treat the 30% number. I'm not sure where you came up with that specific number. It's not hard and fast. For example, if you have $200,000 of equity in your home, and that's equal to 10% of the value because the home is $2 million, the lender is going to take it as collateral, even if it's less than 30%. So those strategies could be, taking out a HELOC so there's not as much available equity. But again, may not happen. There may be, depending on how far in advance it is and where you are in your stage of life, moving it into certain kinds of trusts or irrevocable trusts might help. I think it's a longer answer. And it may be a little bit lender dependent. Someone else earlier had asked on a similar question that if your spouse is on the house but not buying the business, do they have to guarantee the loan because they're going to have to sign on or do they have to sign on the loan? And the answer is, again, lender dependent. Are all of your assets joint or not? That might mitigate one way. But if, for example, you're 100% owner of the business that you're buying and they need to take your home as collateral and your wife is joint tenants with you, your wife will sign a limited SBA guarantee. I believe it's Form 148L, where she guarantees the loan only as to her interest in the home. And then she'll sign the mortgage or deed of trust as well. So she doesn't have to sign the note, doesn't have to sign a full PG, but she will have to sign over her interest in the home to support the loan.
And those can vary even by what state you're in, because marital property is treated differently. So,
Adam, the overall takeaway for the audience should be, though, that they should explore, if they own real estate, they should explore ways to shelter it, right? That is something that we talked about offline and that you help people with.
100%. I think if there's equity in your home, I think there are two reasons for it. The first is that if under the SBA rules, they don't have to take your home as collateral, then why should they take your home as collateral, right? If they're covered elsewhere. The second is that you should always want access to more liquidity. The moment you take out an SBA loan and they put a mortgage on your home, you're not going to be able to take out a HELOC. You're not going to be able to take out a line of credit on your home, or at least not easily. And so 3, 4, 5 years down the line, your home is appreciated in value, and you want to tap into that equity to fund, I don't know, a renovation or something, or just to have. It's going to be very, very hard to do. There's a similar question of, if I have a home, can I sell it, roll in the equity on that house into a new home purchase, and pledge that new home to the lender? And the answer is it depends. Because some lenders, and I've had this happen, will say, oh, you're selling your home, we'll release it. Other lenders have said, oh, you're selling your home, we want to see how much are you getting, and then we want you to prepay some of your loan, even if you would have wanted to roll that into your next home. So yeah, I'm very much in favor, take out a HELOC in advance, because just as a general financial management strategy, you want to have access to the extra liquidity regardless.
Thank you. Just a couple more, everybody. We've heard before about engaging a local credit union bank and try to get similar SBA terms to finance. Is that likely to work? Know anything about that?
So two things, credit unions will require a PG on anyone who owns 20% or more. That's number one. So you're not going to get out of the PG requirement. Credit unions do offer, in some cases, 25-year loans, some cases 15-year loans, 10-year loans, depending. Those with typically rate resets every 5 years. Credit unions are a great option, but it is sometimes very difficult to find a credit union that is willing to underwrite and lend on a pure business acquisition.
Great. Eric. Hello, Eric. Very common advice is to buy as big as you can afford for SBA. For those in the pre-MBA window between a recent undergrad and one with a few years of professional experience, how big can you and should you buy? After this presentation and just appreciating that much more the SBA program, I'm just like, get that SBA money as much as you can. Just kidding, everybody. That was irresponsible.
Well, here's one thing I'll also say is don't make the tail wag the dog. So a lot of times if you have the right opportunity, now obviously if you can't finance a deal, right? So you fall in love with a $4 million transaction, it requires a $400,000 equity check and you just can't get the money. Well, there are investors that might be able to help you with it, but there are certain limits. But I would say that my general advice is find the deal that you really fall in love with. And then as long as it's a solid deal, find a path to finance that. Don't be thinking just in terms of, like I need to get this kind of artificial target.
Yeah, I love that. I agree with that. Somebody said, just to clarify the point, we were talking about partial buyouts and rolled equity and investors. So I'll just repeat one more time. If you are doing an SBA loan and you're using investor capital, you're having some investors contribute equity to the injection, required equity. You effectively will not be able to have the seller roll any equity.
Pretty much, yeah.
Yeah,
pretty much.
And
not officially, it's just the investors are going to have to take a PG to enable that, and no investor is going to take a PG. So de facto, that's the case. Sorry.
You should also know that sellers' willingness to do the personal guarantee regardless is pretty low. So the amount of deals we see with a seller roll now with SBA is like much, much less than it was prior to the rule change. So.
Yeah. And this has made buying tradesy businesses or businesses that require licensing very much more difficult, because then you also have to figure out where you're going to get the license. And usually having a seller participate in the equity was a good way to get everybody bought in. But now that's
a conversation that we have about once or twice a month.
Okay, let's see here. Let me see if I can find one more. There's so many. 63, James David. 63.
Yeah, some of them may just get forwarded to Adam. We'll see.
Okay. This is just sort of kind of a trend question. It's interesting that the SBA requirements are getting more restrictive with respect to seller notes, rolled equity, et cetera. Is that a trend? Is there any legislation around increasing the $5 million cap or improving incentives for buyers?
I think the restrictive trend in many ways is a reversion to the prior rules. So, there was an expansion and now it's back to the old rules. So it's not like they're really trying to do that. Everybody keeps talking about the cap, especially raising the cap to 10 million for manufacturing deals. Stuff has been proposed, but if you're waiting for Congress to do anything, just don't hold your breath.
And in fact, I think
recently,
to Bill's point, and unless you have insomnia, you probably don't want to go back and watch the presentation of the new rules. But one of the things that the SBA specifically said was that they were reverting some of these rules because these were the areas where they found the most defaults. So one example, merchant cash advances, which are no longer eligible to be refinanced on a 7A loan. The reason for that was that a huge percentage of the recent defaults on 7A loans were 7A loans that were used to refinance merchant cash advances. So I think, will they keep tightening? I don't know. I think, like Bill said, it's really a reversion to where the rules were before and a response to very, very specific instances of default or default clustering.
Yeah. Last question. What are you seeing for rates for SBA loans right now, and what should we forecast? I heard it was around 10%, but that doesn't include paying off the loan over 10 years. So is it closer to 15%? Anyway, what are you seeing for rates?
Bill, James, David, you guys want to take this, or you want me to take it?
A lot of times we see floating rates, right? We don't usually see fixed rates on the 7A loans.
Yeah.
It's usually a floating rate of, prime plus 2, something like that, and it resets every couple of years. And, maybe it's a little bit more than that, maybe it's a little bit less than that, and the reset periods can be different, but we're seeing floating, right? Assume it's going to be a floating rate.
There is the occasional acquiring minds guest who got a fixed rate SBA loan. Is that something that you should reach for as a buyer?
So traditionally, the fixed rate loans are available where the sponsor has prior experience and a track record, and the deal is very strong. So that falls into two categories. Either they have prior experience and a relationship with a bank that will do a fixed rate 7A, or they've had the business under their belt for a couple of years and they're going to refinance it. For someone, again, who doesn't really have a track record, is going to buy a cash flow based asset light business, a fixed rate 7A is really usually off the table.
Okay.
At least for the first year and a half, 2 years.
Okay. Great, guys. Well, very, very informative, valuable presentation. So thank you for bringing your expertise, Bill and James David, as always. And Adam, thank you. You were a great addition. You also just a font of knowledge. Bill, James David, what is the topic for next month?
The topic for next month is all the ways deals have fallen apart this year. We're going to have a end of year disaster porn episode.
Yes.
So,
Yes.
and we'll probably extend beyond this year to give other examples, but yeah, all the ways that we've seen deals go wrong.
Yeah. So that'll be a really valuable session. So everyone keep your eyes peeled for that. We'll have Bill and James David back here in 4 weeks-ish. Adam, maybe we'll see you around again. Everyone, the links to Bill and James David and Adam's LinkedIn's, email addresses, URLs are all there in the comments. So click them now because we're about to shut down. Thank you, audience, for coming. Thank you for your attention and great questions. You'll probably hear from James David personally, maybe some from Adam in the days ahead. And watch your inboxes in the today or tomorrow for a link to the presentation and the slides. Thank you, everyone. This concludes the webinar.
Thank you very much.
Bye-bye.